Hi, folks. This is Empowering Democracy, and the topic for tonight is Fed's analysis is plain wrong, or sometimes I say flat wrong. Plain or flat seems to have the same meaning. I see Dolores is here. Hello, Dolores. Thank you for coming. Please do share. I think I'll do a bit of sharing here myself. So, does anybody have any concessions from Mr. Bolsonaro yet? And tonight, that would be news. I don't know if we'll ever get any concessions from him, but maybe so. We'll have to see. Anyway, the Fed is just plain wrong. I'm going to share a piece. This was from Common Dreams. And there's a picture of Jay Powell, otherwise known as Jerome Powell. Title of this is AFL-CIO economist warns Fed is using flat wrong quote unquote flat wrong analysis to inflict pain on workers. This is by Julia Conley of Common Dreams, and it's dated October 26th, a few days ago. The top economist for the largest labor organization in the United States on Wednesday said the Federal Reserve's decision to continue raising interest rates is a, quote, a political, unquote, one, based on a flawed analysis of the causes of inflation. Quote, the Federal Reserve is doing the greatest harm I could ever imagine. William Spriggs, chief economist of the AFL-CIO, told The Hill, quote, I consider what they're doing right now politics, and they are making a political statement about the economy, and they are wrong. Their analysis is flat wrong, unquote. The Federal Reserve has claimed a labor shortage, increased wages, and struggles within global supply chains are to blame for inflation, which currently stands at 8.2%. In response, the central bank has increased interest rates several times this year, most recently by 0.75 of a percentage point. Last month, Spriggs denounced the bank for ignoring external factors that are driving inflation, including the effects of the climate crisis on global agricultural production. As the Hill reported, Spriggs, quote, pointed to a major drought that's affecting rice growing regions in China, a heat wave in Europe that destroyed much of the corn crop, and massive flooding in Pakistan that wiped out huge swaths of different crops, including 20% of the cotton harvest, unquote. Those crises have pushed global commodity prices up by more than 55% this year, with food commodities up nearly 24%, according to the UN Conference on Trade and Development, otherwise known as UNCTAD. For U.S. consumers, grocery prices are up more than 13%. Judging from what we spent at the grocery store today, I think grocery prices are up at least that and maybe a lot more. It's dangerous to the moment to tell the American people that the source of inflation is endogenous to the system. That is, it is related to excess demand, unquote. Spriggs told The Hill, quote, nothing could be further from the truth, diverting us from the actual conversation that we need to be having. We human beings is so dire, unquote. In addition to the impact of extreme weather, as well as Russia's invasion of Ukraine on global crops and the price of food and fuel, multiple economists have pointed to, you guessed it, corporate profiteering and price gouging as key factors that are driving inflation. As Sherrod Brown, a Democrat of Ohio, said yesterday in a letter to Federal Reserve Chair Jerome Powell, such corporate behavior is not impacted by interest rate hikes, and the central bank must take action to, quote, promote stable prices and maximum employment, unquote, for working Americans. That, of course, is the dual mandate from the Humphrey Hawkins Bill of 1979. Progressives have called for policies to provide relief for working families, including legislation that would crack down on corporations that price gouge, and the reinstatement of the expanded child tax credit. The Federal Reserve is expected to continue raising interest rates in the coming months, with a 4.6% rate anticipated next year, up from the current 3.08% effective rate. In his comments to The Hill on Wednesday, Spriggs reiterated an analysis he shared on social media in June after the Federal Reserve hiked interest rate by 75 basis points. Spriggs tweeted, the Federal Reserve missed a key opportunity yesterday to give reasonable forward guidance. Chair Powell chose to emphasize a narrative that our inflation troubles are driven by excess demand. This is a very dangerous narrative. It will prevent policies Data Solutions. And it directs one to get the full conversation on Twitter, Spriggs Full Conversation, which is actually a tweet storm. So let us look at that tweet storm. Let me share it for you. It's quite interesting. And there it is. I just read the first in the tweet storm, or thread if you prefer. Number 1 of 8. Here's number 2. At OECD Economy released its economic outlook and gave a sobering assessment of the global price of Russia's aggression against Ukraine. The American press has ignored the context for inflation. Yes, oil prices were returning to their longer-term average before the war. And here he shows a graphic which is rather hard to read. But if you look at the very end of the graphic, you see the prices are beginning to level off. Food and energy prices have risen sharply, but then towards the end of it, there is a sudden drop in those prices. Then peak up again. But there's evidence that the surge in commodity prices was leveling off. Third in the tweet storm is the American press has ignored that the current spike in oil above previous average price is directly related to Russian aggression. The lack of context also ignores how oil companies had responded to the drop in oil prices during the pandemic by reducing capacity. Of course, that's his statement that it's related to Russian aggression. It is related to the Russian invasion, but there's debate over whether that was aggression, because the Russians at that point invaded in order to put an end to the oppression that the Ukraine government had been engaging in of the Russian-speaking population of the Donbass from 2014 to 2022. That's a justification for intervention that is recognized by international law, and by the UN. I'm not saying that this was plainly a case of a lawful kind of intervention. What I am saying is that the Russians did have an international law-like excuse for marching into the Ukraine, and that the whole thing would have to be adjudicated by the International Court of Justice if someone tried to bring charges. Doesn't look as though any nation is relying on international law right now. But anyway, going to this third tweet, The American press has ignored that the current spike in oil above previous average price is directly related to Russian aggression. Again, take that expression with a grain of salt. The lack of context also ignores how oil companies had responded to the drop in oil prices during the pandemic by reducing capacity. So this next chart shows monthly U.S. refinery capacity and inputs from January 17th to December 2023. Of course, the last part of this is a projection. But the message is U.S. refinery capacity has declined by 1 million barrels per day since early 2020. That could certainly be a factor in inflation in the price of oil. Number four, Spriggs says the return to normal oil prices, normal is in quotes, 2014 to 2016 averages was the result of the gap in demand moving back to normal ahead of oil companies using that to increase profits to make up the losses during the pandemic instead of expanding capacity. He points out this is all a supply phenomena. I think that should be phenomenon, but okay. That was tweet number 4 out of 8. The Energy Information Administration expects high refinery margins to contribute to increasing fuel production this summer. And you see the higher margins highlighted there, okay, in yellow. And then we have tweet 5. The Federal Reserve portrayal that they can control oil prices through lower demand with higher interest rates will only complicate a bad situation. Slowing demand will not affect supply and will entice oil companies to keep capacity low in anticipation of lower demand. This is number 5 out of 8 in the tweet storm. William E. Spriggs, this is 6 out of 8. Global oil prices will continue to face pressures for a long time since the Russian situation will not end anytime soon. I would take that with a grain of salt, okay, as well. So far, it has been possible for NATO and the West to forestall an end to the Russian situation by giving the Ukrainians, roughly 52 billion, okay, in aid, with another perhaps 50 billion to go. As China opens its economy, decreased oil supply will face even greater demand, and the Federal Reserve cannot affect that. But that doesn't mean the Russian situation will not end anytime soon. It looks like the Russians are currently gearing up for a major offensive in Ukraine. They have enhanced their forces by 300,000 troops. That may end the Russian situation a lot sooner than many are inclined to think. Number 7, William E. Spriggs says the Federal Reserve did not help by Chairman Powell's offhand dismissal of the key driver for food prices being Russian aggression in Ukraine. Shrinking global wheat exports by 30% and corn by 20% cannot be offset by U.S. demand falling unless the U.S. goes into a deep recession. Spriggs again for the 8th tweet in the tweet storm. The Federal Reserve, characterizing American inflation as unique and caused by excess demand, prevents discussing policies to ameliorate higher prices for stressed American households, navigating these novel supply shocks and policies to address them. It is a political statement. I have to say, I think William Spriggs is right. The Fed has been acting based on political statements, not acting to address the causes of the inflation. So let's begin to share something else, which may be very relevant right now because the Fed has a meeting this week. I'm going to share once again a recent post by Stephanie Kelton called "When Will the Rate Hikes Break Something?" That's from her Substack, The Lens. And she asks, when will the rate hikes break something? This was on October 7th now, nearly a month ago. There's a lot of concern that the Federal Reserve is going to keep raising interest rates until it forces something to break, quote unquote. I share that concern, she says. If you follow financial markets, then you've undoubtedly heard people like Scott, I guess his name is Minerd, Minerd, say that he thinks the Fed will continue with rate increases until, quote, something breaks. He's been arguing for some time that the Fed is steering us into a crisis by relying on backward-looking price and other signals for guidance about the underlying strength of the U.S. economy. He's worried that if the Fed keeps tightening the way markets currently anticipate, then it will lead to a financial accident that could spill over into the financial markets. San Francisco Federal Reserve President Mary Daly has dismissed those concerns, insisting, we definitely don't raise rates until something breaks. We actually are forward-looking. As Daly rightly notes, the Fed doesn't simply plug some historical data into some kind of Taylor rule model when deciding on its next policy move. The Taylor rule, of course, is a Taylor series. That can be fit to data, and the issue is whether you can fit a Taylor series to the historical data and explain and predict its course by using the Taylor series model. Still, Powell and company appear committed to staying the course, downplaying financial risks and mounting evidence that it has done enough by vowing to keep at it, even if it means hiking into a recession. The uber hawkish Fed has a lot of people worried, including the IMF and the United Nations Conference on Trade and Development. Their case, UNCTAD again, and the World Bank. My friend, CNBC contributor Ron Insana, agrees. He points to the recent turmoil in the UK gilt markets, but says, sorry, I lost my thread here, but says, quote, we are on the cusp of an even bigger break in the global financial architecture as Federal Reserve officials are now doubling down on the need to raise rates to fight what appears to be falling inflation, irrespective of the consequences. Ron reminds us that excessive hikes won't just break something, quote unquote, in the U.S. economy, the labor market, housing, commercial real estate, the stock market, etc. The breakage will spill over onto the rest of the world. Paul Volcker's draconian policies, this is quote again, came with an associated and unanticipated cost, even beyond the deep double dip recession that ensued. This was at the beginning of the 1980s, if you don't recall. Rapidly rising rates in the U.S. put a strain on Latin American nations, which had borrowed considerable amounts of money from U.S. commercial banks throughout the 1970s. Those debts, largely denominated in dollars, were hammered by a combination of higher rates and falling domestic currency values, which effectively and substantially increased the debt service burden on those nations. As rates rose sharply, Latin American nations threatened to default on their outstanding debts, an event that could have rendered many U.S. money center banks effectively insolvent. Volcker had no choice but to stop raising rates and start cutting them to relieve the strains on the U.S. banking system. So even under those circumstances, the Fed raised rates until something broke. If history is any guide, and in financial markets it almost always is, the Fed will be forced to pause, if not pivot, on policy in the relatively near future. They may deny it. They may not want to do it. They may refuse to even acknowledge the possibility of such a drastic change in policy, but change they will, unquote. And Stephanie says, but I'm with Ron. And she basically predicts that there will be a pivot from the Fed real soon now. I hope myself that real soon now is not too much in the future. I fear that it may be, but perhaps Ron and Sana and Stephanie are right. There certainly is a lot of screaming and squealing right now about those Fed interest rates rising and rising and rising, and also killing our labor markets. And the Fed is in a weak position to counter these kinds of criticisms. The reason why it's in a weak position is because the narrative told by William Spriggs and by Stephanie Kelton and by many, many, many economists that the Fed is flat wrong in its analysis of the causes of inflation. And the causes of inflation do not merit this rising interest rate type of policy. Many, many of us have been saying that. And on the record, it is plainly true. The interest rate policies do not address what the apparent causes of inflation are. So the Fed, as Spriggs says, is making a political statement. It is not saying what it is going to do or making policy based on an analysis of the real causes. What's going on here is that the Fed has a little hammer. It doesn't know what to do except to raise interest rates. And so it's responding to pressure from outside, which is basically saying, do something. It has been doing the only thing that it seems to be able to do. God bless you, honey. Thank you. So, to extend this out just a little more, God bless you again. We can see this happening. We can even add that this might not have happened had Joe Biden appointed Lael Brainard as the Fed chair, or Sarah Bloom Raskin as the Fed chair, or Stephanie Kelton as the Fed chair. These politically motivated policies, when I say politically motivated, I don't mean that it's motivated by the Democratic administration. I don't mean that it's motivated by Republican pressures. I mean that these policies the Fed is following, are motivated by Wall Street pressuring, saying, do something. And the only thing the Fed can really do, that it knows how to do, is raise interest rates. At least this Fed, run by this Fed chairman, Jay Powell. That's what he knows how to do. Paul Volcker is one of his heroes. It was a mistake for Biden to reappoint him as Fed chair. He should have appointed one of the three women I just named. So, that's my pitch for tonight. I'm going to check out what you have to say. Okay, Warren Chamberlain came to check us out here tonight. Hi, Warren. Welcome, Warren. And Warren says there definitely is a flawed analysis. People greet one another here. Warren says if the problem is a shortage of labor and other natural resources, it is a supply side appreciation of goods and services, not a demand side inflation driven by higher wages and the supply of money. It is not a monetary problem and cannot be solved by monetary policy like interest rates increases. It is a fiscal policy problem. Yes, Warren, it is a fiscal policy problem. And Kay asks, or Kay says, need to get rid of Powell. Well, I do think that would help. Warren says price stability does not mean stable prices and employment at living wages. It really means increasing and maintaining the exchange value of the US dollar and increase cheaper imports and drive down wages. Well, the way look at it, that way they look at it, that's what it means. That's not necessarily the way we look at it. And Warren Chamberlain says that the monopoly and oligopoly enterprises have the market power to manage their supplies to maintain the optimum price level. There is no real free market competition except as they can manage the supply of labor and keeping unemployment high enough to suppress unions and wages, keeping the workers pitted against each other. Thank you, Warren. I think that was a very good comment. The only way to manage and bring equilibrium, says Warren, by using interest rates to cause a recession and make real investments more costly by increasing interest rates. In this way, it is going to be the cost of living that will keep the cost of interest that will keep the cost of living higher, not lower inflation. As a matter of fact, most of the MMT economists agree, I think all the MMT economists agree, that raising interest rates, as the Fed has been doing, is only feeding inflation, at least in the short run, at least until the economy collapses. Those interest rates, rising interest rates, are inflationary. Warren Chamberlain says, as soon as the general population finally understands this dynamic, the Fed will not be able to maintain its policy and will have to pivot before they cause mass global bankruptcy. Warren Chamberlain says, hi, Joe. Hi, Warren. Okay, thanks for the intervention, Warren. That was well done. Are there any more comments? Okay, or questions? If the Fed does move soon to pivot, Warren says yes until the economy collapses. If the Fed does move soon to pivot, which a number of us think they will, that is going to create a more tolerable situation with respect to inflation. But it's not going to happen overnight. These higher prices are with us for some time because the Biden administration is making no moves to end the price gouging. The price gouging can be ended by regulation and by fiscal policy, such as a windfall profits tax. Those are the kinds of things that have to be done, but Biden should also declare an economic emergency, and he should use his emergency powers to regulate the price gouging out of existence. He won't do that because he has promised the donors nothing will fundamentally change. And ending price gouging is something that the businesses involved in would certainly consider a fundamental change. So that's not likely to happen either. Are there any more questions or comments? If not, then I will say good night. I will be back tomorrow. Hopefully, I'll make it by the late morning. Oh, Warren says, I like a windfall profits tax. A lot of people have been suggesting that, Warren, but I like one of those too. Okay, so anyway, I'll be back in the late morning tomorrow or the early afternoon with a couple of streams. And then I'll be back again tomorrow night, okay, at 9. Uh, Lisa still continues to have some problems that she has to handle. I do hope that she'll be coming back soon. Okay, believe me, though, there are good reasons why she has not been able to participate. Kay says, bye, Joe and all. Love you all. We love you, Kay. Dolores says, thank you, everyone, and good night. I guess that'll do it.